In chapter 9, you have learned about the preparation of simple final accounts in the format of trading and profit and loss account and balance sheet. The preparation of simple final accounts presupposes the absence of any accounting complexities which are normal to business operation. These complexities arises due to the fact that the process of determining income and financial position is based on the accrual basis of accounting. This emphasizes that while ascertaining the profitability, the revenue be considered on earned basis and not an receipt basis, and the expenses be considered on incurred basis and not on paid basis. Hence, many items need some adjustment while preparing the financial statements. In this chapter, we shall discuss all items which require adjustments and the way these are brought into the books of accounts and incorporated in the final accounts. Now, let us see what are the needs for adjustment. According to the accrual concept of accounting, the profit or loss for an accounting year is not based on the revenues realized in cash and the expenses paid in cash during that year, because there may be some receipts of income and payments of expenses during the current year which may be partially related to the previous year or to the next year. Also, there may be some incomes and expenses relating to the current year that are still to be brought into books of accounts. So, unless such items duly adjusted, the final account will not reflect the true and fair view of the state of affairs of the business. Similarly, adjustments may also become necessary in respect of certain income received in advance or those which have accrued but are still to be received. Apart from these, there are certain items which are not recorded on day-to-day basis, such as depreciation on fixed asset, interest on capital, etc. These are adjusted at the time of preparing financial statements. The purpose of making various adjustments is to ensure that the final accounts reveal the true profit or loss and the true financial position of the business. The items which are usually need adjustments are closing stock, outstanding expenses, prepaid expenses or unexpired expenses, accrued income, income received in advance, depreciation, bad debts, provision for doubtful debts, provision for discount on debtors, manager's commission, interest on capital. It may be noted that when we prepare the financial statement, we are provided with the trial balance and some other additional information in respect of the adjustments to be made. All adjustments are reflected in the financial account at two places to complete the double entry. Our earlier example in chapter 9, which represents the trial balance of Ankit, is reproduced here for the better understanding. Now, coming to the trial balance of the Ankit, which is of chapter 9, we have some following entries here, as we have cash, bank, wages, salaries, furniture, rent of building, debtors and bad debts. And we have elements for that, and we have amount in the debit column where it is an asset or it is an expenses. Then we have purchases, capital. In capital we have equity, then sales, creditors, long-term loan which is raised on 1/4/2004. So here we have both expenses and liabilities. Expenses and asset will be amount showing in the debit column, and as when coming to the income and liabilities, the amount will be shown in the credit column. Then even we have commission received, which is an income, where the amount has been shown in the credit amount column, where the total was 1,62,000 for debit as well as credit. And what was the additional information given there? additional information we have, the stock on March 31st, 2005 was 15,000. It is nothing but the closing stock. By considering the same example, let us see where the outstanding expenses will be incurred. So when coming to the wages which is outstanding, we have added in the trading account of the Ankit where the previous outstanding was 8,000 and the current previous wages were 8,000 and current outstanding is 500. Since the wages will become 8,500 and there will be a change in the gross profit which is 56,500. Then coming to bad debts, again it was shown in the debit side of profit and loss account where bad debts will be recorded 4,500. Now the outstanding wages which we have shown in the trading and profit and loss account, the wages what we have recorded there, the same have to be considered in the liability so that we have to pay that which is outstanding, which is our liability to pay. So the same will be existed in the liability side, wages 500, or you can even record it as outstanding wages which is 500. Now let us take the concept called prepaid expenses. So there are several items of expenses which are paid in advance in the normal course of business operation. At the end of the accounting year, it is found that the benefit of such expenses have not yet been fully received. A portion of its benefits would be received in the next accounting year. This portion of expenses is carried forward to the next year and is termed as prepaid expenses. Now let us take the same example of the Ankit where we are going to for the trading and profit and loss account. So here coming to the example of Ankit again, so salary what we have in the debit side of profit and loss account 25,000, in that we have considered 5,000 which is paid in advance where the benefit is not received. That 5,000 we are going to deduct from the salary, 25,000 minus 5,000, then the outer column will become 20,000. So salary became 20,000 and the same will be affecting the profit of the particular year. So where previously the profit was 19,000, now the profit will become 24,000. So because for what expenses we paid for the salary which is 25,000, it became 20,000. The excess 5,000 what we have, it is meant for the next year, it will be carried for the next year. So in this year it will be added to the income where the net profit became 24,000. And the same will be affecting in the balance sheet where 5,000 was added to the profit and the same 5,000 was considered as prepaid expense. So same prepaid expense it will be shown in the asset side of the balance sheet, prepaid salary 5,000. It means that this year it will remain as a asset and the profit will become 24,000. Then it will equalize the liability and the asset. Now let us take the next concept where we have accrued income. It may also happen that certain items of income such as interest on loan, commission, rent, etc. are earned during the current year accounting year but have not yet been actually received by the end of the same year. Such incomes are known as accrued income. So now let us take the same example here and we'll see that take that commission accrued 1,500. So here commission accrued is what? Which is supposed to receive but not yet received. So where we are supposed to receive and we have not yet received that. So that particular income we are going to add to the income in the particular profit and loss account. So where we can see in the trading and profit and loss account of Ankit where in the credit side we have commission which is 5,000 and we will take accrued commission as 1,500. So where it will be added to the commission 1,500 and there will be a change in the net profit where the net profit was 24,000 and it will become 25,100 and same will be affecting the balance sheet. So coming to the balance sheet, the net profit will become 25,500 and what commission we had, So in that commission 5,000 was considered in the trading and profit and loss account, and only the difference we are going to take in the balance sheet. In the asset side we are going to show it as commission, or we can show it as accrued commission. In the asset side 1,500. So difference was 1,500. The same was added to the net profit here, 1,500. You can consider the previous balance sheet where the total was 24,000 was the profit. Here the profit became 25,500. The next concept we have is income received in advance. Sometimes a certain income is received, but the whole amount of it does not belong to the current period. The portion of the income which belongs to the next accounting year is termed as a income received in advance or unearned income. Such income we are going to show in the liabilities side, so that it will be the liability of the business which have to be met with the expenses of the next accounting year. Now let us take the example where rent received in advance 3,000. So the same will be appearing in the balance sheet in the liabilities side, rent received in advance 3,000. So as I said, it is meant for the next year. This year it will be the liability of business. Next year it will be considered for paying that particular expenses.